This is the online financial school. This series of lectures on life insurance are part of our effort to improve financial skills and we use this platform for delivering the skills. This lecture number 3, is about whole life assurance. It is also about endowment assurance. These are two very popular policies. Very popular because they basically meet the common man's perception of insurance. They really meet the needs of the common man. So if you are looking at savings, protection, these two policies provide both savings and protection. They offer good commission to the agent, which is very important, and they offer good guarantees and options. Whole life assurance, if I could start with that, is a policy that offers cover. It's a protection product. There is a subtle savings element to it because you get paid your money anyway, and the payment is guaranteed. So there is a very long period of cover. After the long period of cover, you die and you get your benefit. So there is cover for life, and you get paid on death. There is no maturity value because cover is only paid when you die, whenever. The policy is one of those really peculiar policies because traditionally and normally you try not to pay surrender values on protection policies. But this is one policy where you pay a surrender value because it's got a subtle savings element, and this makes it not so bad. It's a much better policy than a term assurance. People like this policy a lot better because of that property. The sum assured is guaranteed, premiums and expenses are also guaranteed. So you don't get the insurance company coming back to you to say, we want more premium, or we want to reduce your sum assured. Everything is signed up for as it is, and once you sign up and you pay premiums as required, then you don't expect nasty surprises. You don't expect any variations over time. It's a very simple policy. Get covered, pay your premiums as required, and if you die, then there will be a sum assured paid. As I said, this is a protection policy, and as with protection policies, you are trying to get healthy lives on your books. So the underwriting is very strict. very similar to term assurance of same sum assured. So if I'm covered for 1 million for whole life, or I'm covered for 1 million for term assurance, you expect the same underwriting standards. Similar anti-selection issues do arise. People will forever be trying to get insured and take advantage of insurance companies by dying early and get paid a benefit. So sick people will come looking for insurance. You have to guard yourselves against that possibility. You have to protect the insurance company, so you underwrite very, very strictly. We come to endowment assurances. These are fixed term policies with a maturity date. So you have a fixed term policy which is very similar to a whole life assurance. In fact, it helps a lot to think about an endowment as a whole life assurance with an accelerated death benefit. In other words, you are covered for a fixed period. If you die during that period, we pay the sum assured. If you survive to the end of the period, we pay you the sum assured at the end of the period. This is a policy that has both protection and savings aspects. The protection is that if you die during the term, you get paid the sum assured. The saving is that you get paid the sum assured on maturity. So you get your benefit whether you die or you live. And this is a very good thing because it makes this policy very, very popular. And the reason why it's popular is that this is a policy that meets the common man's conception and understanding of what insurance should be. You know, it offers benefits in almost any situation. When you compare it with the term assurance policy, you have a maturity value which is paid. You have a surrender value which is paid. So in many ways, because you pay a maturity value, you are addressing the policyholder's fears that he pays money to the insurance company for nothing. You are addressing the fear that if he surrenders, you will get nothing. You do not have to die to get your benefit. So this is a policy that really addresses every need of the policyholder. If you're looking at the way it addresses the need, you surrender, you get a benefit. You die, you get a benefit. You survive to maturity, you get a benefit. There is a sense of you cannot lose with an endowment assurance. You get your money either way. That's the sort of perception that the common man has got about an endowment assurance. And most importantly, I think we should say this, that it pays good commission to the agent who sells the insurance. So it's very popular. So talking about endowment assurance, I think it's a policy that really meets needs in a very comprehensive way. You could be asking yourself, so where is the catch? Why would anybody else be interested in anything else? I need to address the other side of it. The fact that the endowment assurance, for all its advantages, has disadvantages. It can be very, very expensive. It can be poor value for money. and this applies to both the endowment and the whole life assurance. It can also be very poorly targeted. So when you get insurance, it's better to get insurance for a specific purpose rather than be covered for a whole lot of time for general purposes. So in many ways, there might be better value in separating the protection aspect of your insurance from the saving aspect. There are benefits in the sense of improved efficiency, improved value for money, and better targeting. And that might mean breaking down your cover so that you use a combination of term assurance sometimes with a unit-linked policy to achieve the same benefit, sometimes more cheaply or sometimes for a bigger benefit. So it's important for you to understand how the breaking down happens so that you can build your policy properly.